Hello everyone, welcome to my course on capital investment. This is module 3 of this course. In this module, we are covering cost of capital, and this is the first lecture of this module. And in this lecture, we will cover key assumptions and the basic concepts of the cost of capital. Now, let's look at an overview of cost of capital. First of all, cost of capital creates a link between firms' long-term investment decisions and the wealth of the owners. We know that objective of the firm is to increase overall value of the business, or in other words, objective of the financial managers is to increase the market value of firm shares. So in this case, cost of capital works as a magic number that can be used to decide whether a proposed investment will increase or decrease the firm's stock price. Or in other words, cost of capital should be the minimum rate of return that a firm must earn from its investment. Now let's look at the firm's capital structure. In a capital structure, in one side there are assets, uh, liabilities, and equity. If we look at the sources of long-term fund, we can consider long-term debt or bond as the sources of long-term fund. In the meantime, there are some equities which are also considered as sources of long-term fund. These are preferred stock, and in the meantime, common stock and retained earnings are also sources of long-term funds. There are some key assumptions for cost of capital or for investment. First of all, business risks. Business risks in general means if a firm becomes unable to cover its operating costs, and in this case, it is assumed that business risks will remain unchanged. This means acceptance of a given project will not affect firm's overall business risks. Secondly, financial risks. In general, financial risks means firms' inability to cover required financial obligations. And it is also assumed that in case of investment, financial risks will remain unchanged. It means the projects are financed in a way that will not affect firm's ability to meet its financial cost. And finally, it is also assumed that after-tax costs are considered relevant. That means we will find out that cost of capital will always consider after-tax cost. It is especially relevant to find out the cost of debt. In case of cost of debt, we'll always consider the after-tax cost of debt. Now let's look at some basic concepts. First of all, why should we consider weighted average cost of capital rather than a individual source of cost of capital? Now let's look at the project. Look at this example. For this, for an investment, ABC company needs an initial investment of $100,000. It has a internal rate of return, that means IRR 7%, and least cost source of financing is debt, which is 6%. So IRR of this investment is more than its least cost source of financing, which is debt, 6%. So the financial manager is more likely to accept this project by comparing IRR and the cost of capital of this project, which is the cost of debt. Now let's look at another example. Now here the firm has got another opportunity which will require same sort of investment, and it has also usable life of 20 years. In this case, IRR of this project is 12%. And for this project, the least cost source of financing is only equity, and its cost of capital is cost. That means cost of equity is 14%. Though this project provides 12% rate of return, still this project will be rejected because the IRR of this project is less than the firm's cost of capital. Now, if you compare these two projects, the first one provides an IRR of 7% rate of return, which is comparatively low and only provides 1% more return than the cost of capital, but still this project is accepted. The second one provides a attractive rate of return of 12%, but still this project is rejected because the least cost sources of financing considered by the financial manager is equity, and it is 14%. And for this reason, we should always consider weighted average cost of capital. Now, if the firm use 50% debt and the cost of debt is 6% and 50% equity, the weighted average cost of capital will be like 10%. So if my firm use 50% debt, which costs 6%, and 50% equity, which costs 14%, firm's weighted average cost of capital will be 10%. And if the firm uses weighted average cost of capital uses both debt and equity, firm can easily accept this project with 12% rate of return. With weighted average cost of capital, firm's cost of capital will be 10% and IRR of this project is 12%. In this case, second project will be more attractive for the firm with 12% rate of return because first projects only provides 1% extra rate of return. If the firm uses weighted average cost of capital using both debt and equity, the second project will provide 2% extra return. And for this reason, a firm should always use weighted average loss cost of capital rather than a individual sources of cost financing like either equity or debt. So we have already learned what is meant by weighted average cost of capital. We have also learned that firm should always use weighted average cost of capital from these above examples. And over the long term, firm must undertake investment that maximize firm's value. So if a firm accepts a project which provides a rate of return more than the weighted average cost of financing, it will increase or it will maximize firm value in the long run. That's all about this lecture. In our next lecture, we'll learn the cost of long-term debt.